Yeah, I think we are live. Hi, Shankar.
Hi Ajay. Uh, Good afternoon, everyone. We'll wait for a couple of minutes for a few more of our attendees to join in, and then we'll get started with the webinar.
Sure.
Hi Ajay. I think we can get started, right?
Definitely, Shankar.
Yes. Good afternoon, everyone. Good evening if you're there in different time zone, and welcome you all to the Marmor webinar series. This is our webinar titled "The GCC Private Equity and Capital Landscape, Venture Capital Landscape." Before we get started with the webinar, I would like to give you a small brief about Marmor. Marmor is a wholly owned subsidiary of Marcus, Kuwait Financial Center, and Marmor, we offer research-driven market advisory and consulting services across the region, in the MENA region, and we are very focused on the GCC as well. We've been in the business since 2010. It's been 13 successful years of our journey, and we have served multiple clients in many sectors, including banking, asset management, and various other industries in the GCC. And our journey continues. As a part of our knowledge dissemination and publication series, we would like to get started with today's webinar on the GCC private equity and venture capital landscape. We know that the last 2 years have been years of growth and years of tight economic conditions. The post-COVID recovery was strong, but post that, many challenges came which affected the asset management, wealth management industry, the private equity market, and so on and so forth. In this webinar, I'd like to introduce my colleague, Mr. Ajay Samvel, who's also the Senior Manager of Research in Marmor. He would like to take us through what are the key trends that have shaped the private equity and venture capital landscape, both at the global stage as well as in GCC in the last 1 or 2 years. I'll leave it to you, Ajay, to take it forward.
Thank you, Shankar. Thank you so much, and welcome everyone to the webinar. Thank you so much for taking time off to attend our webinar on GCC, PE, and VC landscape. Before going into the global PE and VC landscape, I feel it's important to take a look at the current macro setting, as most of the major industry shifts are tied down to the global macros. So when we go and look at the global macros, two I's seem to be the major talking points this year. One I is obviously inflation, and the other I is interest rates. Inflation in 2020, we saw inflation climbing up to double digits. Although the inflation has been tamed down to an extent right now, based on recent signals, we see that inflation is still sticky, especially in economies like US. Even though it has eased down to levels of 3.7%, it is still above the target range for the Fed. So indications from the Fed seem to be that we have further interest rate hikes, and also due and more than earlier expected, we see interest rates to remain at a high level, maybe even till the second half of 2024. At the turn of the year, the situation was quite different. In 2023, when we entered, we knew that inflation was quite high, and so. But there were signs that inflation was easing. So we expected the Fed pivot to take place somewhere close to the end of the year, or maybe in the start of 2024. But as per recent trends, what we see is that inflation is expected to remain sticky at the current levels, which could mean that we could see that interest rates would remain longer, which would in turn lead the Fed to postpone their decision of pivoting until at least the H2 of 2024. And based on the comments of the US Fed chair, soft landing is not their baseline scenario, even though there is a possibility that is not the base case which they expect. So all this, what it does is it adds to the uncertainty in the markets. So when we move on to the market conditions, even though public markets have done well quite a bit in the past first half of the year, we still see a lot of risks. But investing always entails risks. Risks can generally be quantified and planned based on logic and history. But the biggest problem when you see for the private equity and the venture capital industry is that more than risks, it's uncertainty. And uncertainty is something which could lead to a pause in activity, and exactly this uncertainty has played out in the past 4 quarters, which from the graph, if you could see, the deal activity worldwide has slowed down from the highs in 2021, and right from H1 2022, we see activity slowing down to a great extent. This is majorly tied down to the uncertainty in the markets. So this uncertainty is also leading, is having a trickling down effect for both investments, exits, and even fundraising. They have all been sluggish since the mid 2022, when central banks started aggressively hiking rates. How long this scenario will persist is anybody's guess. But in our opinion, what we feel is that we don't see much wrong fundamentally in the system, which warrants such a slowdown for multiple quarters. Especially if you compare this to the previous GFC, macros are much more in a better place compared to what we saw in during the GFC, where there was a lot of pressure on the financial system. There are still one-off events like pressure in the housing markets right now due to high mortgage rates, the SVB collapse, the takeover of Credit Suisse. But the events have been few and far between. So the scenario is not as bad as GFC, but uncertainty still exists in the market. So deal-making activity eventually has dropped for multiple quarters. But what this has led to is there is a severe buildup in dry powder as well. The capital which is available in PE funds has also raised substantially. And also another point in terms of exits is that currently there are close to 2.8 trillion in unexited assets, which is nearly 4 times that of the global financial crisis. So we are seeing this trickling down effect from the exits to fundraising. Due to the lack of exits, what we are seeing in terms of fundraising is that there is pressure in raising funds because exits itself has not happened so far. So due to this liquidity crunch, fundraising has been become difficult as well. And if you see the comparison between H1 2022 and H1 2023, fundraising has also been substantially lower. And in terms of deals across regions, the decline has been broad-based and has been witnessed in all the economies. And between regions, we see that Middle East has been much more resilient compared to other regions. North America, if you see, has witnessed a decline in deal value by close to 50% in the first half of 2023 compared to the previous H1 2022. And also on a sectoral basis, we see IT still dominating in terms of deals, and it amounted to nearly 153 billion in H1 2022. This has also significantly dropped to 76 billion in H1 2023. So for an industry that has been used to raising large funds every year, especially when you see 2021, the amount of activity is quite less and unprecedented. Even if the macro scenario for the next quarter or maybe next 2 quarters is still weak due to high interest rates, there is excess buildup of dry powder as well as unexited portfolios. So we expect activity to gradually climb back to previous levels in the next 2 quarters, followed up by a much quicker and a swift recovery post H1 2024.
Thanks, Ajay. Thanks for giving us a very good global context of how the PE and VC markets have been. And it was very nice to understand the analogy between the years of the global financial crisis in 2008 and what's the scenario now. I noticed that you mentioned about Middle East being one of the better performers in this landscape. Could you give us more details about the GCC markets particularly? Were they better off? What were the drivers for that? How did they manage to perform better amidst all these uncertainties that have been prevailing at a global level? Probably if you could throw some light in that, that would be really interesting.
Definitely, Shankar. As I said, I think the activity in Middle East has been much more resilient when compared to other regions. Although the PVC market is like 1/10 the size of North America, there has been traction within the Middle East, and the number of deals have also been high compared to other markets. So, in terms of deal value, the number of deals by value, the number of deals have been high, and the value of the deals have reached close to 9.7 billion in the first half of 2023. This is much higher than even H1 2022, where the deal value was 9.5 billion. This is for the whole MENA region. Contrary to the global landscape, P and VC deal volume has jumped more than 50% when you compare the values to 2019. And most of the activity has been driven by UAE, closely followed by Saudi Arabia. In terms of sectors, where we see a lot of traction is in fintech, transport, logistics, and also e-commerce. So UAE and Saudi have been the major markets in this region, and they have also attracted a lot of investment among the GCC countries. A stable economic stability, favorable demographics, and also a stable political environment have contributed to the rise in number of deals in the region, and making Saudi and UAE more attractive destinations compared to other emerging markets, which are not as stable as UAE and Saudi Arabia. When you look at the PE and VC, when you look at GCC in a PE and VC landscape, GCC is usually considered as a source of capital rather than a destination of investment. This, however, has changed in the past couple of years, where GCC countries have been actively demonstrating their vision to diversify their economy away from oil. Particularly, the UAE has become very attractive for PE investments, with the country accounting for most of the PE activity in the region. In terms of PE and VC-backed deals and investments between 2018 and 2022, you see nearly 4 times activity in UAE when you compare to Saudi, which is the second highest market. So in terms of magnitude, UAE is way ahead compared to other markets. But in recent years, we are seeing a lot of traction in Saudi Arabia as well, due to several reforms, several stimulus injected by the regulatory authorities and the governments. So in our opinion, what we feel is that there is still a lot of untapped potential in the region, especially in markets such as Saudi Arabia and Kuwait. So due to this, we expect PE and VC activity to improve in the coming years. So when we look at some of the factors that are driving growth, one of the major factors is the robust economy of GCC countries. GCC, when you compare it to other emerging markets, they have significant qualities which put them apart from other emerging economies. Like, for example, they have much higher reserves, and their economy is in a much stronger position compared to other emerging markets. Due to the high fiscal buffers, they're able to weather any economic shocks that their economy might face. If you see the amount of reserves to GDP, GCC countries have the reserve to GDP ratio is nearly 32% for GCC at 2023. But when you compare it even with the largest economies in the emerging space, it is much higher than China, which has a reserves to GDP ratio of 7.4%, and even more higher than India, which has a ratio of 4.5%. So due to this due to the strong economy, fiscal buffers, low debt, and the lack of currency risk, since they are pegged to the US dollar or a basket of currency, they're in a much stronger footing when compared to other emerging markets. So another factor which has been influencing the growth of SWFs is that the PEVC industry is that they have very strong sovereign wealth funds. GCC sovereign wealth funds manage close to 3.2 trillion assets on an aggregate basis, and they have some of the largest sovereign wealth funds in the world. And even in terms of activity, the number of deals done by GCC sovereign wealth fund in 2022 was much higher compared to other sovereign wealth funds. And when we talk about SWFs in the GCC, especially for Saudi Arabia, Saudi Arabia's PIF, there has been a change in strategy. Earlier, the SWFs used to invest a lot globally, but after 2018, 2019, we see a change in strategy from these large SWFs, where they have started investing a lot in their domestic economy. This is done in order to improve the business environment in the Middle East, which also ties up with the goal of GCC countries, where they would like to diversify their economy. This shift has also had a very positive impact on the startup sector, and which has in turn improved the PE and VC industry. If you see PIF, it has been on the forefront of this change, wherein they have one of the major initiatives has been the setup of SoftBank Vision Fund, which they have established with the partnership in partnership with Japan's SoftBank. So this has given a positive impact to all the other sovereign wealth funds, which are also increasingly improving their focus to their domestic economies. And also, if you see in terms of economic diversification, the GCC governments have they also have very long-term vision for their economy, wherein they focus on certain strategic pillars like education, like improving their reliance on renewable energy, so improving private sector role in the economy. They have a lot of initiatives stated in their vision, for which they have also pledged a lot of capital. And another factor which is driving the industry is the increasing importance of the technology sector. Uh, if you see GCC, the technology adoption is much higher compared to certain other economies in the developing world. So due to the increase in technological adoption, we see this trend trickling down to the industries as well. So there have been a lot of investments going towards improving the technological infrastructure across the board in different verticals. So this increasing importance is also spurring the startup ecosystem, which is helping the growth of the PE and VC industry. So, as I said, there are several government initiatives which and from the regulatory side, and also in terms of spurring the private sector economy. If you see UAE, they have been launching sandboxes which incentivize. Which kind of incentivize investment which incentivize startups to thrive in an ecosystem. So since they have these kinds of sandboxes, smaller players are able to test some of their upcoming and emerging technology on which their whole startup or their product is built upon. And also in terms of the regulatory side as well, we see several improvements both in Saudi and UAE in amending the regulations so that the business environment is in a much better place compared to what it was 5 years ago. Again, when we see UAE is like the hub for startups in the region. So due to the friendly business regulations and the infrastructure setup, UAE has been at the forefront in encouraging innovation. But recently, we see several initiatives from Saudi Arabia as well, especially in the past 3 to 4 years, uh, like uh, like a lot of initiatives from their regulators, tying with their government authorities, which are focused on improving the startup ecosystem. So we expect these measures to get materialized pretty soon, which would lead to higher deal activity and higher activity in the PEVC space. In terms of Kuwait, they have also come up with certain initiatives like the launch of National Fund for SMEs, which was actually set up much earlier in 2013, and it aims to finance up to 80% of the capital requirements of SMEs in Kuwait. So, due to these initiatives, we see much more activity in the PEVC industry across the GCC compared to years before. And we have also seen a lot of major deals happening in recent times. And a lot of these deals have been backed by SWFs. Some significant SWF-backed deals in 2020 include the acquisition of a 55% stake in Emerson Electronics Climate Technology. This was done for a compensation of compensation of close to 11.7 billion. And another deal which took place was the acquisition of Zendesk, which is an application software company, and this deal was done for a proceed of USD 9.9 billion. So additionally, we see in addition to PIF, we also see a lot of activity from Abu Dhabi Investment Authority, which is the investing arm of Abu Dhabi. So in terms of the large deals, it is still driven by some of the SWFs. But we see this trend to continue in the upcoming quarters as well. And we see this trend trickling down to other economies such as Kuwait as well to invest a lot in the domestic economies. So in terms of the major players, we see a lot of GCC-based players having a lot of activity in recent times. And some of the major players are in detail profiled in our recent report, which is on private equity and venture capital in the GCC region. So in the report, we have a very detailed profile of some of these players. But now I'll just give a brief of some of them here, like Gulf Capital, Invest Corp Bank, Java Investments, These are some of the major players within the major domestic players within the GCC. And if you see some of the sectors which they have been focusing on, we see trends like health tech, fintech emerging as very hot sectors that is seeing a lot of PVC activity in recent times. We also see a lot of activity when it comes to clean and alternate energy as well. This is one space which we expect further traction in the coming quarters as well, in addition to health tech and fintech. So in terms of VC players, we see a lot of investment in the tech space, which in itself is a broad space. And also we see a lot of the similar trends repeating in the VC space, wherein fintech companies are the chief target for investments. So moving forward, what we could see is there are a lot of investment opportunities available across sectors in the GCC. One of the major sectors of focus would be retail. Before diving into the sectors, based on our understanding, sectors in GCC could receive further traction based on two major factors. One, it should either be driven by consumer spending or it should be driven by government spending. So based on these two factors, what we see is we see certain sectors are in a much better position compared to others to draw further activity from VC companies. One of those sectors would be retail, where we see a lot of scope for growth, especially in the e-commerce side. The industry is primarily driven by the region's growing millennial population, trends such as urbanization, and the focus of GCC economies to improve tourism, both in terms of sports tourism, religious tourism. These trends are likely to play a major role in the development of the retail space. And even within the retail space, we see UAE leading the region. And another trend which we notice especially in UAE is that it is a very ripe market for luxury goods. If you see the retail sales of personal luxury goods, we expect the sales of luxury goods to improve to close to 11 to 12 billion. So the market is close to 11 to 12 billion market, which is expected to grow at around a CAGR of 6 to 7%. So another sector which we feel is very ripe is the education sector. Due to the demographic structure of GCC countries, the demographics is tilted towards a younger population. So, and even education is one of the top priorities of the GCC countries, which is stated as per their vision programs. So we expect a lot of investment to flow into this sector to improve the quality of education. And we also see a lot of regulatory leeway being given in the sector, which would encourage further investments from the private sector. Another sector which we saw earlier was the healthcare sector. Healthcare or probably health tech is a quickly emerging field where we see activity in types of spaces majorly. One is that if you see a lot of developing markets, the demand for healthcare is growing to unsustainable levels, wherein you even have to wait for a month to get a doctor appointment. So there is a lot of when there is adversity, there is innovation, as people say. So a lot of companies are trying to come up with innovative products and solutions in the healthcare space, which could help in bridging the gap between demand and supply within the healthcare space. And another space where we see a lot of activity is developing software for these fitness equipments that are focused on a consumer level. There is already a very strong market for industrial healthcare equipment, but in the future we see a scope for consumer healthcare equipment as well to grow probably in the next 5 to 10 year time horizon. Another sector where we see a lot of traction is the renewable energy space. As you know, one of the key pillars of economic diversification would be to reduce the reliance on fossil fuels. GCC economies have been struggling a bit lately, mainly due to the volatility in oil prices. So, what they intend to do is to reduce the consumption of fossil fuels, which in turn frees up a lot of fossil fuel for exports. In terms of in a global level, we see demand for fossil fuels to exist probably even till 2050. The demand for fossil fuel is expected to remain steady due to a lot of industrial application. Even if there are other avenues like alternate fuel such as hydrogen, nuclear power, and electric power, the demand for fossil fuel is expected to remain firm in the short term and even at the short to medium term. So GCC economies are trying to free up a lot of fossil fuel resources for exports, and this can be done only if they make significant investments in renewable energy. And GCC have already begun investments in this sector. And due to these investments are expected to trickle down to a lot of smaller players within the region, where some of the parts or some of the solutions could be outsourced to regional startups. So this is one sector which we again have an eye on. And lastly, it would be the infrastructure sector. Infrastructure is also expected to receive a boost due to some of the factors which I already mentioned, which is included in some of their vision statements, wherein a lot of developments need infrastructure building. So, in terms of capacity, there are going to be a lot of logistic projects. There are going to be a lot of projects pertaining to airports, commencement of seaports, maybe even enhancements of these projects. So in terms of the infrastructure sector as well, we are quite positive in the short to medium term. So in terms of challenges, generally there have been certain challenges that has stifled the growth of PEVC industry in recent years. So one of the major structural challenges is that GCC region itself is the business landscape is dominated by family businesses. So traditionally, family businesses have played a very vital role in in the economic growth of GCC region. So the major problem is that since these family business have control a large portion of the unorganized economy, what happens is that they are very reluctant to relinquish control. When they why they're hesitant is that they don't see the demarcation between control and management. So due to this hesitation, we are seeing a lot of family businesses continuing their operations and at the current scale and not ready to scale up, because they feel that once there is a third party player like a PE or a VC fund investing in their family business, their control or their inputs in terms of decision making will suffer a bit. But we see this trend to change in the coming years, because the world is I think even when you see the family businesses, they're aware of the changes in the industry, and they've been investing a lot in technology as well. So the difficulty of general partners to gain control and invest in a lot of family businesses is expected to change in the coming years. And another significant barrier for PE and VC firms is performing due diligence, and this is compounded by the information paucity in the region. So when compared to other regions, the available of information from the regulators and also in the public domain is quite limited. And due to information paucity, a lot of private equity and venture capital firms, foreign venture capital and VC firms, what they do is they ignore the GCC region due to the lack of information and the inability to do proper due diligence. But we see a lot of changes happening in this front as well. Because in recent times, what we've seen is GCC markets such as Saudi and Kuwait have been upgraded to MSCI markets because of a lot of regulatory changes brought down by the CMA, capital market authorities of Saudi and Kuwait uh, for the listed companies. We expect these best practices to trickle down to the private space as well, wherein when this is like a start. So when the public companies start improving their disclosures, we expect the disclosures from the private companies to improve as well in the coming years. Another challenge has been limited corporate governance. So, in terms of bookkeeping, in terms of providing necessary information, accounting, the companies in the region do not follow international standards, and this has been a formidable challenge for investors to gain access to financials of the private company. So again, as I stated earlier, we expect corporate governance to improve as well due to the push from the regulatory authorities. And also there is one challenge which we see is the dearth of qualified human resources. So due to a lot of restrictions in workforce, we there has historically been a gap in finding the right skill sets uh, to be employed in the correct roles. Say, for example, in the healthcare sector, it is a very niche sector that requires a significant expertise of the field. So there has always been a bit of a skill gap in previous years, but the trends are much better right now, uh, wherein we see a lot of talent within the region and also an openness for expats to move to the region in such roles. And another challenge has been the hurdles in establishing SME in the region. If you take out Dubai or UAE, the other GCC countries have historically had a lot of problems in establishing SMEs, which involves a lot of time as well as an increase in cost. When the time increases, the the movement of a product from the ideation stage to the markets also increase. And due to this time lag, sometimes products and solutions either become irrelevant or it leads to higher costs for the industry, and this has been a deterrent. And again, mainly Saudi has been improving a lot in recent years to reduce these hurdles. And also, Kuwait has been implementing a lot of measures to remove these hurdles and make it a much attractive destination for foreign investments. So that they could be at a level field with the UAE in probably the next 5 to 10 years. Just to sum things up, in terms of the global PEVC market, we see a lot of sluggish activity due to higher uncertainty over interest rates and inflation. These effects are visible in the PE in all the facets like investment, exits, and also fundraising. But due to a buildup of high dry powder and unexited portfolio, we see a knock-on effect on fundraising as well. But due to 4 or 5 quarters of inactivity, we expect that the activity in the next few quarters is expected to. We expect the activity to improve gradually. And once when we have much more clarity in the global macros, maybe in the second half of 2024, we see P and VC industry to exhibit a lot of growth. And in terms of MENA region, what we've seen in the past 1 year is that they have been much more resilient compared to other regions across the globe. And this higher activity has been majorly driven by UAE and Saudi Arabia. So structurally, the GCC and VC industry might not be as mature as other developing markets, but however, due to a lot of regulatory initiatives and government initiatives, especially in UAE, Saudi, and Kuwait, we see these initiatives bear fruit in the next couple of years, which would attract significant interest from global investors. So, with further reforms and initiatives, we can expect the GCC, VC, and PE industry to kick on and exhibit growth in the coming years.
Thank you, Ajay. That was really insightful. And what I can see as an emerging theme in this sector is that while there are a lot of challenges that you highlighted, but measures are already being taken by various governments and activities are being uh, happening, which means that there is a lot of potential for the PE and VC activities to increase in GCC. And especially with Saudi and UAE pushing ahead with reforms, these two nations really stand out within the region as well. With that, let's keep the floor open for our audience to uh, key in their questions in the chat box. Please do key in the questions. While our audience send in some of their questions, I have some questions which have been sent to me beforehand. So we'll get started with them. One key question that has come out, Ajay, is like, how do you see the interest rates panning out in the next 1 year, and how do you think this will affect the global as well as GCC, P and VC market? We've seen that interest rate has been a major factor in the past. Do you see interest rates coming down sometime in 24, or is it sometime in 25? What's your general take about that?
The movement of interest rates is like $1 million question right now, wherein we see a lot of activity happening on a monthly basis. Even if you see the economic data of the US, I think last year inflation level was around 10 was close to double digits. But now we have seen significant progress in the toning down of inflation. So higher interest rates have definitely helped in taming down inflation. But what you see from the last few months is that inflation is remaining sticky, and due to which the Fed has had to adopt a very hawkish stance, which which changes the macro scenario quite a bit. Wherein earlier, when we entered this year, P and VC activity was slightly lower in the expectation that macro scenario will improve at the end of the year and maybe in the first quarter of 2024. Due to that, there has been a buildup of dry powder, and also a lot of portfolios are still unexecuted due to the difference in valuation between the buyers and sellers. So when the interest rate landscape has changed, it has added to a lot of uncertainty in the markets. So what this does is uh, on a theoretical level, we expect the sluggishness to move down in the next quarters. But there has already been a lot of buildup in the past 4 to 5 quarters. So we expect the activity to rebound slightly. And in terms of interest rate, our expectation is that in H2 we would be seeing a pivot from the Fed. At the current juncture, we expect one more rate hike of 25 bips from the US Fed this year, and from that we expect a plateau in interest rates, which we expect to pivot from H2 2024. And in terms of PE activity, we have to look at the macros on a monthly level because it is very dynamic at this juncture. So, in a baseline scenario, what we expect is that the higher interest rates are expected not to have a very devastating effect on the markets. In that case, we expect P and VC activity to slightly improve in the next 2 quarters. And after that, when Fed gradually reduces their interest rates, we see a scenario where there is a much sharper rebound in the second half of 2024.
Thank you, Ajay. Couple of more questions are coming in from our audience as well. One theme that we see emerging in the GCC MENA landscape is the combination of tech and the traditional sectors. So, how do you see sectors like agri-tech, logistics and technology attracting more deals, especially in the PEVC space? Is there a huge potential, or are there hurdles on their way? What's your take on that?
Absolutely. I think there is a lot of potential in agri-tech and food tech, especially considering that we had a Russia-Ukraine crisis, which altered the supply chain dynamics globally. So, as you know, GCC is a more import-dependent economy when it comes to food and other food and beverages. So we already see a lot of startups cropping up in Saudi Arabia in the agri-tech and food tech space. So GCC, and even if you see the vision of UAE and Saudi, they are expected to improve their food security in the coming years, and it is an important long-term objective for these economies. So definitely there is a lot of traction in terms of agri-tech and food tech, especially in Saudi, in addition to UAE. We see deal activity to improve in the coming quarters. And in terms of logistics and mobility, there is definitely much higher scope as well. And anything tied up to technology is in a very strong footing, like say health tech, fintech, agri-tech. We see a lot of activity in startups related to technology, which are also relevant to other business verticals. So in terms of agri-tech, yes, we see a lot of activity. Logistics has always been a very important strategic sector, especially due to GCC. Some of the GCC countries want to become a logistic hub. So and also drive tourism. So we expect logistics and mobility also to play an important part in the deal activity moving forward for the GCC region.
Thank you, Ajay. That was really insightful. Considering the time, I'll go with one last question, and then if there are any further questions from the audience, we'll respond to them over email. And even after the webinar, if there are any questions, feel free to reach out to us. One final question, Ajay. We all know that Saudi and UAE have been very active in terms of all these activities because of their reforms, the sandboxes that have been very successful, and so on. How do you see the other nations in GCC catching up? Are there any initiatives coming up from countries like Kuwait, Bahrain, and Qatar? Or do you still think that there's a lot of reforms that need to happen for these countries to get more active on the PE and VC side?
So based on the evidence from the past half a decade, UAE has always been in the forefront because the initiatives which they took up was started much earlier when compared to other countries in the region. It has taken a lot of time for markets such as Saudi to open up and become more investor friendly. But as soon as these changes have taken place, we see a very sharp improvement in the past 3 years in terms of deal making, in terms of PEVC activity. And also, what we feel is that markets such as Kuwait, Qatar also have a very strong potential. And especially in Kuwait, you see a lot of improvements driven by the regulatory authorities, wherein the laws, like the mortgage law, bankruptcy law, have all been in the works, and we expect further traction to take place in the regulatory side as well, which would improve the business landscape of markets such as Kuwait. So the potential is definitely there, but in order to see activity in the PEVC space, it generally takes time, because when these reforms are put in place, the industry improves gradually, and probably in the next 3 to 5 years, we expect markets such as Kuwait and Qatar to be in a much stronger footing compared to what they are now.
Thank you so much, Ajay. Thank you, thanks to the audience for the patient listening, and do reach out to us if you have any queries on the GCCP and BC landscape. We'd be very happy to share more insights, and do reach out to more in case of any business requirements. We'll be very happy to connect with you. Once again, thank you, Ajay, for the very insightful presentation. We'll share the recording of this webinar very soon to you via an email. Thank you, audience. And we would continue to do more webinars in the coming months, and we'll be very happy to share more insights on economy, banking, asset management, technology, and various other uh, areas in the GCC and the MENA region. Thank you all for your patient listening. Have a very good day. Thank you so much.
Thank you all. Thank you.